You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to this week's edition of the Systematic Investor series with Jerry Parker and I, Niels Kostrup-Larsen, where we do our best to bring you into the world of rules-based investing by sharing our knowledge and hard-learned lessons over the last few decades, hoping that you can avoid making some of the mistakes that we did. So, Jerry, it's just you and me today. So, good morning. How are you doing?
I'm doing great. Good morning to you. Hope you've enjoyed your stay in Florida.
Yes, it's funny. We're both. It's early morning Saturday. We're both stuck in a hotel somewhere in the States. So, doing our best to get this out to you, the listener. And by the way, if it is your first time tuning into our conversation, we hope that you will enjoy an hours of hopefully some informative, but also maybe entertaining content. At least we'll do our best to deliver just that. Of course, we're getting close to Christmas, the holidays. But when I was looking at the markets this week, it certainly seems to me like Christmas may have come early in the financial markets. I mean, we had a week where both, quote unquote, a trade deal was signed between the US and China, or at least phase one, I think they call it. And we had a clear election result in the UK. And then, of course, we have massive amounts of liquidity still being pumped into the system, despite some really strong U.S. unemployment figures from last week. So, of course, markets reacted as you would expect. Now, of course, what's interesting is at the same time as the Chinese were signing this agreement with Trump, I noticed in the news that China has, or Beijing has ordered all government offices and public bodies to remove foreign computer equipment and software within the next 3 years. So I'm not sure what open markets really mean when it comes to that. I'm sure it's not surprising to people listening to us today that stocks dominated really the week in terms of returns. Although I would say it's interesting when I look at the kind of 40, 50 markets that I always kind of keep an eye on every week. I mean, most markets were up this week. There are very few markets that went down. And of course, the VIX was the biggest drop this week, but most markets went up. Pretty strong moves in some of the commodities. From a performance point of view, on our side at least, stocks were dominating. So that's where we made the money for the week. It was a decent week. But interestingly enough, although equities did really well, the biggest winners for us were the Mexican peso and soybean oil. So, bonds, of course, in light of what happened, risk on means usually bonds sell off, which they did. And on our side, it was really mostly the Australian fixed income markets that did a little bit of damage, as well as the UK gilts, but not enough to spoil a really good week. Getting back to kind of flat line for the month and still a pretty good year for trend followers in general. So with that in mind, Jerry, always interested to hear how your week went, and since there was so much activity in the equity markets, maybe you also had some more activity in the in your side of the portfolio that obviously trades single stocks.
Not too much going on there actually, but I agree with you on some of those market moves. It's sort of interesting to see. Now it looks like Boris and Brexit is a positive thing, and the pound rallied, and all is well. So it's kind of a surprise, and I think we, in our point of view, had a trend change in the pound. So interesting to see what's going to happen to those markets. And I was looking back over that British pound chart and the big crash, and then fast forward a few years, is a big rally. So just following the trends, and we'll see what happens there.
Yeah, I mean, that's a good point, actually, because when people start talking about Brexit, of course, a lot of the UK markets came under a lot of pressure, including the pound. Now looks like we are getting Brexit, and now that's, as you say, it's a positive, which is obviously quite interesting. But actually, I also, and I don't want to jump into the Twitter just yet, but I did notice one of your last tweets from maybe this morning, maybe from last night, where now the Europeans, the politicians who have been, obviously putting up a hard line towards the British. Now they seem to be talking about how UK can be the Singapore of the Thames, and how they want to have the best possible relationships and the widest possible ways of dealing with them. But so it seems like Boris's win has changed a few minds, not just in the markets but also in Brussels, I would say. So fascinating to see how things change and how the narrative change. But of course, we need to dive down in some of the other Twitter activity this week, and interested to hear what you've got for us.
Well, we sort of talked about before we got on this one tweet or one article we both kind of like from Cambridge Associates. I'm not sure where I found this, Moritz maybe, but I'm not sure. And I pulled out some selective quotes here. I think overall a positive article, but a little kind of, I don't know, silly, or maybe we were having a hard time thinking it was consistent or interesting. But the quote is, while we believe CTA trend following can once again deliver appealing, uncorrelated, and attractive returns, it's likely that those returns will be unreliable, undependable, and lumpy. Undependable, unreliable, disappointing, lumpy, frustrating, painful, non-correlated, but historically attractive. Returns are a long-time feature of trend following. All of those words were in the article, and so I know it sounds a little silly, but maybe sometimes we feel like attractive returns, non-correlated returns are not good enough. It needs to sort of be nice and smooth, but I feel like that the best part about that quote is that it's sort of a feature of trend following. It's the way life is, and you take the good with the bad, and in the end, hopefully it'll be positive.
It's a feature of trend following. It's a feature of life, I would say. I mean, nothing goes in a smooth line. Why would trend following be any different? But of course, I know that people are deceived or attracted by some strategies that look incredible smooth and low risk. But I going back to the article, and of course we have respect for the people at Cambridge Associates, and they deal with a lot of institutional investors. The article has a heading or headline called, "With trend following funds down sharply this fall, should investors fish or cut bait?" And to me, it's funny that's even a question, right? Because when you go back in time, and people can look at your track record, they could look at our track record, and every single time there's been a decent drawdown in trend, I would love to see the evidence that it wasn't a good idea to buy it. And that goes for most strategies, right? I mean, when things are on sale, so to speak, it's usually a better time to invest than jumping in at a new high, which of course might feel emotionally better. But performance-wise, it's usually not a great thing to do. So, I mean, it comes back to also the question of timing, right? I mean, as you say, this article in some ways could be said also to be a little bit silly in some ways, because deep down what we believe is that you need to build robust portfolios by having a core allocation to trend following, and we shouldn't spend too much time timing it. You know, the whole idea that we need to be judged and measured all the time when we're having, possibly 20, 30, 40 years of investment horizon, when we really need the money, so to speak, to retire. I mean, who cares really what the score is after 5 years, after 10 years? I mean, what you want is you want to be winning at the time when you need the money. With all investments, they're unpredictable. And just because equities have had a great run for the last 10 years, in my personal opinion, and we try and stay away from predicting anything, but in my personal opinion, it doesn't set up the next decade that we're about to head into in a particularly good way when you've had such a strong run, because history tells us that these things don't last. The only challenge is we don't really know how long wait until we see a change in the macro picture. But that's just the way it is, and that's why we want to build these portfolios that don't rely on a particular environment, on a particular asset class, et cetera, et cetera. So I commented on the article and said I think it makes some fair points, but still, I think what it's missing is the patience. I think we as investors, we as people, we've lost the virtue of patience. Everything has to always perform and be better. And I think if we take that attitude, especially with investing, where usually the less you do, the better you perform, I think we're losing a very important ingredient in setting ourselves up for success.
It's patience and pain. I mean, in almost any area of life, almost any adult would acknowledge that to get good things, one has to be patient and go through a fair amount of ups and downs and pain. And yet, doesn't mean in some areas we won't try to avoid it and write things like this. We talk so many times about one of the key ingredients of long-term track record is long periods of underperformance. And, it's the whole, we've talked also about how there seems to be a bubble in private equity, and a part of the reason so many people really like private equity is because they don't see the lumpiness. There's no mark to market. The pain is sort of hidden, and they kind of prefer that. The investor prefers it. Oh my gosh, it's one thing for, like, I wish we didn't have to show our daily, monthly performance. We'll just let you know in a year or two. But for the client to be driving it, it's pretty crazy, actually.
I mean, it's just fascinating, really, that I think deep down, most people, they know this. I mean, if you sat them down and you talk to them, I mean, I think it would be hard for them to rationalize anything other than what we're trying to say. And by the way, I mean, I think a lot of people, and I've seen that in the comments from time to time, where people say that we repeat ourselves every week, and we do, and we make no apology for doing that, because it's so important. I mean, sometimes you can tell people what to do, but it doesn't mean they're going to do it. And frankly, I mean, some of the concepts we talk about have been around for a long time, but and a lot of great people have talked about them for a long time, but still probably 95% of people out there are not doing it. So that's why we need to continue to, quote unquote, repeat the message. Even if it's simple, it's still difficult to get people to embrace it. And I find it interesting that at this time in the cycle, after 13 years or 12 or 13 years of equity markets going up, there seems to be an increased level of bullishness for equities. One thing I noticed, and this is really interesting. So I was called up by a very good friend of mine just yesterday, and he was saying, have you read the latest news in the Danish financial newspapers? And I said, no, I haven't. I'm traveling. I haven't. And the article was about how one of the pension funds in Denmark, and I'm sure it's going to come elsewhere, we're now coming out publicly saying we need to shift from fixed income to equities because we're just simply losing money and we can't afford to stay in the fixed income market. So we're shifting a good part of our portfolio to equities. And this CIO was basically saying, we only have a relatively small amount to do. I can't imagine the problem some of the really big pension funds are having. So it wouldn't surprise me if we get now a new wave of more liquidity heading into the equity markets, even after this long period of time. And so it's going to be a classic, or I think it could be a classic example where people get the most bullish, get the most exposure to equities right before something, changes. And so, yeah, and I'm sure people know that, but it just seems like we can't help chasing things at the wrong time, which is also why I don't think you should chase trend following. I mean, you shouldn't get more excited about the strategy after a good year, and you shouldn't get depressed after a bad year. I mean, last year at this time, the industry was down double digit. This year, in December, we're up double digit, pretty much, at least most of the leading trend followers and so on and so forth. So having this unemotional approach and having this really consistent approach and long-term view is critical.
That's right. I got a little distracted when you talked about Denmark because I read in the New York Times this morning. Have you seen this article?
No.
The world wants more Danish TV than Denmark can handle. The streaming boom has led to huge international demand for shows from this tiny country, but there aren't enough professionals to produce them. So,
There we go. Yeah.
when I first started trading, I was told that if it's perfectly fine to have a plan in place if trading doesn't work for me. And so for you too, if I know you're being very successful now, but there is a demand in another profession that.
Yeah, clearly. It's funny. So I haven't lived in Denmark for 25 years by now, and but I do know that it's true. I mean, Denmark has actually produced some TV series that suddenly is turning up on English television and in other countries. So yes, I guess they have been they found another little niche where size doesn't matter. You can produce good content even if you're a small country. And hopefully people listening to us feel that we can produce decent content even though we're just two people and two mics sitting in two hotels somewhere in the US.
Exactly. So the next paper we saw, we got Moritz found this one, and it was pretty interesting. And I think these are smart people too. But it just shows that if I can selectively pull out quotes to make things look silly or to criticize, but I'm not really criticizing this. And it's just an interesting observation, actually. But the quote goes like this: due to trend following's larger historical risk-adjusted performance and its long-term decorrelation against traditional assets, typical approaches in deciding optimal allocations may lead to unrealistically large allocations to trend following. There is a clear trade-off. Larger allocations to trend following bring more defensiveness to the final portfolio, but come at a cost of higher tracking error. And then I just ask, it's not lower returns or more risk, so why not just choose the better risk-adjusted performance? And how can the better risk-adjusted performer be an unrealistic large allocation? So obviously it's because the traditional assets, stocks and bonds, the investment world revolves around them, and they're the center of the universe. And it's just presumptions that they are the core. Although we include stocks in our portfolio, we include bonds, which just with a heavy dose of systematic trend following that gives us some sort of attempt at protecting capital and getting into the right trades at the right time. So once again, I'll stick with my trend following plus nothing allocation and not care too much about what happens with the buy and hold in the stock market.
Yeah, and so I think the article that you're quoting from is something that takes the starting point is a 60-40 portfolio. And that's another thing that kind of, strikes me as being incredibly interesting. And that is that, people are afraid, and with people, I mean, the large investors, I guess, they're afraid of standing out. They're afraid of being different. They're afraid of not tracking the benchmark. Yet, I would imagine that they should be focusing on trying to beat the benchmark. But you can't beat the benchmark unless you're willing to do something different. And I don't mean to offend anyone when I say this, but being different doesn't mean a 1% allocation to trend following. That's just not enough. Unfortunately, the math doesn't work. And in order to have success in investing, you need to be brave enough to stand out and have the courage to not do like everyone else. And I think that not just in investing, but frankly in business in general, the people we can look back at who have been incredibly successful. Just think of Amazon and Apple. Just take those two. They didn't become successful from doing what everyone else was doing. That's for sure. Why would it be any different? And I think it's a shame that there is so much focus about whether you're as you say, deviating from the benchmark or tracking error. I mean, what does that even mean? If you're doing well, you should embrace tracking error. The more but it sounds like they make it sound like it's a negative, right?
Exactly. I mean, it's irrespective of performance. Or it's just this, it's a given. What we've seen over the past 10 years, I mean, please ignore the 10 years before that, but what we've seen over the past 10 years, those returns are a given. That's a given. So almost by any measure, adding this silly alternatives, commodities and currencies, and the use of trend following is to be suspect, because it's going to deviate from our tried and true guaranteed, 8%, 9%, 10%, whatever starting date you use. Oh, but it does come with that nasty 50, 60% drawdown.
Yeah, and I wonder whether we could even transfer this conversation to the Sharpe ratio, right? Where our strategies don't look great when you look at the Sharpe, but that's partly because a lot of the volatility we deliver comes to the upside, but we get penalized for that compared to other strategies that looks like they have this amazing Sharpe and everyone is just focused on that, and then suddenly they're down 50% and oops, the Sharpe didn't really mean a lot.
And that's back to that lumpy thing. That's why we got to embrace the lumpy, because by taking the small losses and being diversified and having shorts on, we're playing fast and loose with these open profits and giving them more room. And they're up and they're down, and coffee's up 200 on Friday, then it closes down 600. So the markets are all over the place. But you know what? It's a profit, and we're going to let it run, and we're going to allow the lumpiness, because that's what it takes to stay in a trend for a year or two and make the outlier moves. So this is not a negative. It's the evidence of freedom that you have to do that when you have your risk management house in order, by making sure those losses are small and your leverage is reasonable and your diversification is ever present. I'm just thinking, I mean, I don't know where to fit this into the conversation, but I was just thinking like bean oil and some of these other markets that were looking at coffee, things like that, British pound, and crazy markets that are people don't have a tendency to have a lot of. These things are breaking out and making new highs, and maybe the start of something big, and you're just not going to get that type of potential profit and diversification from something that's sort of stock centric.
I mean, that's a good point, and I would encourage everyone to go back, find a chart of soybeans, and go back 30 years on soybeans, and you'll find that on a reasonably regular level, soybean prices tend to drop about 50% every so often. But it also means that if it's dropped 50%, in order to go back to a new high, it has to make 100%. These are trends, and you can see them. They're so easy to spot. And why wouldn't you have something in your portfolio, something in your arsenal that can participate in these things? I think another thing, Jerry, is that we focus a lot on outcome, right? I mean, we get measured every day, every month. We have to publish our returns every year, and so on and so forth. So there's a lot of focus on outcome. But probably the truth of the matter is that the only way to be truly successful in many things, but including in asset management or portfolio management, and in our case in trend following, I mean, you have to love the process. Because as you rightly say, I mean, we're taking inherently volatile markets, and so we accept the lumpiness, and we accept the fact that it can feel at times as a bit of a roller coaster ride. So unless you enjoy the process, unless you enjoy the longs and the shorts and the diversification and all the good stuff, it will be uncomfortable. And I think, but I would just encourage many more people to focus more on the process and falling in love with that. And as we talked about last week, I think it was the difference between liking something and loving something. I mean, you love despite. And so love the process despite the fact that it will be lumpy and it's not going to be in a straight line. But if you end up in a place, if you can get yourself to a place like you, like me, and many of our peers, of course, where you truly love the process, it's going to feel so much better. And I think your outcome will then take care of itself, and it's going to be a lot better.
Exactly. I think people get stuck in situations where they'd like to be able to focus on things that they believe are more correct and more true.
Yes, and controllable. I mean, I think we often believe that we can control things that in reality we can't, and so embracing, knowing what we don't know, as Larry Hyde would say, it's just so important. And I hope for the young generation, I mean, I hope we have lots of young listeners every week. And I just hope for them that that's something they're going to take to heart, because they can apply it in everything they do and will be doing for the rest of their lives. And patience. I mean, even if you spend 5 years, not necessarily end up doing what you will end up doing for the rest of your life. I mean, it's okay. I mean, spend 5 years finding your passion, finding what you truly believe in, and then spend the next 50 years doing that. I mean, we need to have the long perspective on so many things in life.
The next article reminds me about our conversation about the British pound and Brexit, and now it's great. The UK is strong. Maybe it's too strong. The experts, they spin and they spin back, and you can kind of get confused. And a good example of how we like to follow the price. So a couple years ago, we were short the pound. Everything's going to hell. Now the pound's at new highs. It's maybe a trend reversal now, and now Brexit is only because Brexit is a sure thing. And a crazy person like Boris is now the prime minister. So anyways, pay attention. I guess my point is, let's pay attention to price, and it's usually a better guide than the fundamentals and the conventional wisdom. And the article from the New York Times this week, entitled "How a Strong Job Market Has Proved the Experts Wrong." The American economy is capable of cranking at a higher level than conventional wisdom held as recently as a few years ago. The old view of its potential was an extremely costly mistake. Just what is possible just a few years ago is that there's a lot we don't know about what's possible and how strong the U.S. economy can get. And so smart people and experts and paying attention to the buzz, sometimes it'll help you cut short your profits.
Yeah, and again, I mean, you can expand on that, meaning, I mean, even if something has had a certain pattern in the past, and if you get to 3.5% unemployment rate in the US and so on and so forth, this will by definition lead to inflation. Well, we haven't really seen inflation for a very long time, and so again, like you said, I mean, price. Why not just keep an eye on that, and that be your guide, and with people, I mean, don't look at what they say, just look at what they do. That's usually a better guide than that. Yeah.
I have a very loyal following of Twitter followers in there, and I tweet a lot. I tweet different things. 90%, markets and trading and trend, but like you said this morning, I tweeted some other things, and most of the time, only the trading tweets are sort of paid attention to. But my most favorite tweet this week was about football, American football.
Oh,
it was quite unusual, and it talks about math taking over the NFL and models and systematic decisions taking over the NFL. And this one team in particular, quote, "The model evaluates the process, not the result. It isn't swayed by emotion. It will indicate which choice, on average, will produce the most wins. Even in situations where the regret is very high, the model is often right by a lot." Yeah, so that's this model systems approach, backtesting, seeing what works in the past, making conservative assumptions about the system and a model and rules that you can use going forward is applicable in lots of different fields, and that's a pretty good description of the way our models work, I guess.
Yeah, and of course, math and stats in sports became became publicly known when Michael Lewis wrote the book Moneyball, of course, with baseball and the movie that came later. And it is a great example, and it's a little bit very similar to, I think, what we do, right? So we use the stats like they were picking players based on certain things that they needed to be good at, and they mixed them together, and they got a strong team. And we do the same. Our model, our models and timeframes and so on and so forth, markets, etc., are good at different things, but when you put it together, it's a stronger unit. Whatever analogies we can find to try and illustrate the strength in what we do and the core concepts that we apply, I think is super useful. And everybody loves sports. I know certainly in our office at the moment, I don't know if you do that at Chesapeake, but there's a lot of fantasy football going on right now. I think we're heading into the last couple of weeks of games, so there's not that many teams left. Most people have been knocked out, but maybe next year I should enter the competition as the only European and apply some math and some stats in my choices. I might have to call you to get some help.
Yes, that's a fantastic idea. Wouldn't it be so much fun for you to win that league? Yes, and I think and one thing that I would comment on that is that I'm in fantasy football and I'm very into it, and fantasy hockey. And I finished I didn't make the playoffs, but I did have one of the higher total scorers, points scored, but my points against me was the most as well. So even though my team was great, I didn't have a defense for when I played other people. They had a tendency to have their best games.
Yeah.
But in hockey, it's kind of funny because I feel like I have an edge in hockey because I don't know anything about hockey.
Right.
I don't know the players. Like I know I have my system and my spreadsheet for fantasy football, but then I do a little override. I've seen these people play. The numbers aren't perfect, but I think the numbers are more perfect. And I'm doing better in fantasy hockey because I just follow the numbers. I have no clue what most of these players are doing outside of Tampa. So, just like the markets, it's sort of better to not know what a soybean is and not focus on these issues or try to ignore them and just follow your rules. And so I think you could, I try to take over some of my systematic rules-based investing ideas into the fantasy world. It's really fun.
Yeah, and I think maybe for the benefit of maybe the younger generation of the listeners today, I mean, you and I have kind of a reference point to real life example because one of our friendly competitors back in the day, John W. Henry, who obviously were a well-known CTA trend follower back in the day, left the industry. And I'm sure that there's been, and I don't know this for certain, but I have a feeling that some of the things that work well for him in his CTA business, that he applied that to the businesses he went on to buy. One, of course, baseball, and they became won the World Series, but then also European soccer, where his team last year, Liverpool, became the best team in all of Europe. I mean, this is probably not coincidental that you take someone from an industry like ours and he immerses himself in baseball, and then another sport that I'm sure he had very little experience with, if anything, yet he ends up producing two of the best teams in the world. I mean, go figure.
And boy, I bet you there was such a struggle to bring that sort of world into the sports world, where making decisions and choosing players is done in such a different way historically, that there was probably a lot of pretty difficult. Probably hasn't stopped yet either, where more inroads will be made to where there'll be more of a math game and less of what we grew up with, I suppose. But such is life.
Yeah. But another thing, just because we're just the two of us today, so we have a little bit more speaking time, I guess. I've seen it in another way as well. So when I started the podcast, I had to learn a little bit more about social media and stuff like that. And when you look at the people who, for example, have become really popular and blown up on social media, et cetera, and of course a lot of them do that through running ads of certain things. But I bet you when you look at these people, it's all about the math, right? They don't just run ads for the fun of it. I mean, they look at the numbers, they tweak, they twist, they cut the ones that are not working, and they let the ones that are working run. That's not different from anything we do. So these core concepts, whether people like it or not, really are they're a life concept. They're skill sets that you can apply to so many things, whether it's sports, life, et cetera, et cetera. Something actually that Larry Hite talks about in his book as well. But I'm not sure people sometimes makes the connection that that's what a lot of these successful people are doing. Yet, as soon as we start talking about it as a strategy, trend following, suddenly it's not as attractive as you would think.
Yeah, reminds me of my Twitter tweet that I pinned to my page that has gotten a lot of love, but I thought it kind of funny. This comes from an article in hedgenordic.com, and it was a roundtable discussion, and I think some CTA friends at Aspect were on the panel. And I tweeted a lot of the ideas from that long article. And one of them was a quote from I think an institutional investor who said, "We found that many of the diversified macro hedge fund strategies boil down to return streams that are captured in simple trend following strategy. The underlying types of strategies run by hedge funds are very common." I thought that was kind of funny. And we've often said that okay, if you're in love with stocks, maybe we can trade a few more stocks for you to where the stocks are more 30, 40, 50% of the portfolio, with a few commodities and currencies, rather than more diversification is what a typical CTA would offer. But still, that's a lot of crisis alpha when the trend following is wrapped around the stocks and the bonds, your core, the things for some reason you're more fond of or want to get more of your performance from. That's where systematic traders can add crisis alpha, is protecting those profits, getting you in the right stocks, getting you out of at the right time, be it via a trend reversal or a small loss.
Yeah, I mean, I think, of course, there are many strategies, and there are many successful strategies that I would classify as not being trend following whatsoever. But when you look at what most people do when they invest, right, they buy something for it to go up and sell it again. I mean, that is trend following. They're looking for some kind of directional move. They just don't think about it as trend following, right? Even a lot of the short-term strategies, they don't call themselves trend followers, but in reality, they're trend following, but just on a very short time frame. So whatever we call it, directional strategies or trend following strategies, I mean, they certainly play a big part of many aspects of the types of investors that we come across. Yet, as soon as you label it trend following, it just seems to attract some level of negativity, as if it doesn't work well enough. And of course, we have all this evidence, right? We have all of this evidence of it working for decades. Not that many strategies have that level of evidence. So I'm just I'm fascinated by how we are being perceived relative to how I perceive it. I think it's a fascinating conversation, and I would love to ask more people what rationale, what rationale do they use? What assumptions do they use when they look at these different types of investments? And also, of course, how they blend together the effect of trend following has on a traditional portfolio. I mean, what kind of assumptions are you using to get to a conclusion that you shouldn't have trend following in your portfolio? I just would love to know. So if anyone has any opinion about it, tweet Jerry, tweet me, send us some kind of feedback, because I am really interested.
Especially if it's something other than, we'll just look at the last 10 years. And this has taught all of us that stocks are where it's at and what's going to happen. That's where we should have our money. And, but I think that's it in a nutshell, is that performance drives. And once again, don't pay attention to the 10-year performance prior to these past 10 years, because that was negative. And it's just, there's a tremendous pressure to be part of the group. And if the group fails a little, okay, that's fine. If the group is succeeding, that's great. And, that tracking error is a real thing to lots of people. And it's just situations and have gotten themselves into where that's the game that they're playing. It's more like politics. I thought of that article. I thought the first thing that came to my mind was, this is politics. These guys are PhDs in math, but this is a political article because tracking error. It made no sense,
Right. Oh, there's no doubt you're right in terms of the last 10 years, and I think this decade that we're finishing now, will go down as the decade where diversification didn't work. When you do have diversification in your portfolio, or certainly as a portfolio manager, you often probably have to apologize in the eyes of the investor, because why didn't you just have more money allocated to what worked? But of course, nobody has a crystal ball. We don't know this, and of course, you can just look at people like Ray Dalio, whom I often refer to. He would argue that the biggest secret to his success was the fact that he used diversification between uncorrelated assets, because he realized early on in his career that when you blend them together, it allows you to take more risk for the or to make more money for the same amount of risk, or to have lower risk associated with the money you make, and so that was the secret. That hasn't changed. That hasn't changed just because equities have done really well the last 10 years.
But that only works if you take all that diversification and wrap it in a trend following or a systematic strategy, because long only, you're down to a couple of asset classes and maybe gold, and a little bit of gold. And if you just look back on history, bonds are positive and stocks are positive and gold. And so the only way to get the true diversification with the currencies and the commodities is to have a systematic approach, and there's no fall off in performance. When you add all of these crazy markets and the shorts, you don't make less money. You only get the diversification. But of course, that hasn't worked as well over the past 10 years as it did the previous 10. So we're talking in a circle here. What's long term? What's short term? How long should we wait? All these subjects we've covered many, many times, and it always leads back to the same conclusion. We're not ready to change our mind about what is the best way to go forward.
Yeah. No, and I agree. And actually, I think that it's become harder to find truly uncorrelated return streams to equities, frankly, at least on a long-term consistent basis. I was actually doing some analysis this week where I was just looking at our full track record since 1974, and not only does it beat the S&P, despite the S&P having done well, but it has a minus 0.05 correlation. Who wouldn't want that? I know it's the same with your strategy. Who wouldn't want that? And it's almost like a lot of people chooses to just not accept the evidence for whatever reason. I think people have gotten the message today, Jerry. I think we've been very clear about our opinion.
Yeah, another more kind of trading trend-centric topic that was in that article that I kind of enjoyed, and I recommend people read it, was this concept of diversification. I thought this was something that we've talked about correlations, diversification a lot, and how to put together a portfolio. And I think we've tried to be humble on this subject and talk about how hard it is. But one of the sentences I read, a couple sentences I read, I liked. kind of looks at it in kind of a really good way. The person says we are focusing a lot more on drawdown correlations and making sure that you don't just have artificially low correlations. We have low correlations in periods that matter, and that is really the heart of the problem. I have a diversified portfolio of equities, but they're going to all go down a lot on the same day and same week if the stocks crash. They probably will. And maybe I'll be short some of them and long some of them and flat some of them. But, the correlation numbers in the markets that we trade, they hide the fact that we still have some sort of risk where they all can be highly correlated, especially in the sectors. I think it's an area that CTAs and people who are committed to a diversified systematic trading can do better, because it seems like we have a lot more correlation sometimes than we end up having when it kind of matters. CTAs have had some bad months, and this year, all in the bonds probably. Oh my gosh, but they're kind of diversified and they look a little bit different until they don't. So I think it's an area of research and improvement, I think, that we can all continue to strive for, because it is such a difficult thing to understand.
Yeah, no, I agree on that completely. It's also a very, it's an area of interest for us on our research side. I think correlation is important, and of course, I guess we know that there are periods where things correlate more than others. Of course, we know when things get bad suddenly, correlations tend to change quite rapidly, and maybe it is a little bit different today than it was 20, 30 years ago, because a lot of the economies around the world have been completely synchronized, and they follow more or less the same rhythm. So that in itself also drives, I think, higher correlation to some extent. We know the interest rate cycle seems to be completely correlated in terms of the central bank action and so on and so forth. But this is also why having managers who include all the commodities, who are not sacrificing size or sacrificing portfolio choices for size, I think over time will be proven that it pays off. And most importantly, I mean, we make these choices because we deeply, deeply care for the end investor. People say they do. Not everyone does. We know that. So I think it's always important to look at the manager, or how are they incentivized at the end of the day. What is the real motivation of the manager? And of course, it should be to generate returns for the investors. And so being cognizant about that, and including the line of markets that over time will provide good opportunities and robust portfolios is important, even though right now it's so easy to maybe also dismiss that, because frankly, in the last few years, commodities haven't done that well for trend followers. It's been the financials that have really done best, but it doesn't mean that that's how it's going to be in the long term.
No, and that's our job, is to take the short-term pain and not look at things in the short term.
Yeah. Do you have more tweets you want to dig into?
Yeah, let's finally get to the very interesting podcast, Meb Faber, Andreas Clenow, of a few weeks ago. And once again, it'd be great to discuss this with Andreas and get his point of view on some of these things. He talks positively, and I encourage everyone to listen to Meb's, all of his podcast. There's a new one coming out that just came out that I'm looking forward to as well, a guy from NDR. But Andreas starts by saying, talking about the positives of longs and shorts, which we've talked about over the past few weeks. But he describes trend following, maybe this might have been the title. Trend following is about taking a lot of bets on a very few large number of markets. But then he goes on to say this so-called money management things, most of those things are gambling methods. They have no basis in mathematics, no basis in finance. I think he's sort of talking about risk and looking at risk as the risk per loss we're going to risk 50 basis points of our AUM per trade, 25 basis points per trade. So we kind of, on one hand, it's all about making these bets on these markets, but then he's not happy with, I guess, us not concentrating more on volatility and Sharp and things like that. So that'd be a good thing to talk to him about.
Yeah, for those who follow and have read Andreas Clenow's books, I mean, in particular, I think I think it was the first one, Following the Trend. I really liked that book when I read it, because it's good at visualizing for people what goes on inside of a trend following system. And even though I've said this before, I'm not necessarily a big fan in making everyone believe that they can become a trend follower. I don't think that's true. I think it is very, very difficult. It's a difficult craft. It's difficult to do, and so it's not for everyone. And I don't say that to discourage people from trying, but I think, or I say it because I hope it allows people to understand that it's okay to try and fail, and then you adjust and you figure something else out. So, but anyways, Andreas is going to come on the show in early January. I think probably the second week of January. So if you do have questions, if you're familiar with his work, and you have questions for Andreas, then already now you can send them to info@toptradersunplugged.com. And if you could put in the subject line, question for Andreas, then it's easier for me to sort. And but of course, questions for us every week are very welcome. And of course, same address, info@toptradersunplugged.com. Jerry, we've got one question today that we can dig into.
Yeah, let's do it.
From Drew.
Let's do it.
All right. First of all, thanks, Drew, for sending it in, and thanks for your kind comments. We appreciate that. Drew goes on, my question is about how to deal with entries as they create a breakout of the historic look-back period intraday, but then closes back below the breakout level. I know some of you only run your program on the close versus trading the exact breakout moment intraday. I've seen at times a few days where we get an intraday high only to close below the breakout level, but the new intraday high creates a new breakout level, and this can repeat for days, meaning you eventual entry of a close above the look-back period can be almost an ATR away from the original look-back breakout point. Have you tested these different issues, and what are your thoughts? Perhaps your look-back only looks at close, or would you take the trade that creates the new intraday high while closing below the breakout level if you only trade at the close? And then he goes on. I know Jerry wants to say just test both. So anyways, it's a good question, Drew. I think that's, for those of you who are into the building the programs, building the systems. These things occur. You get a signal on the day, but frankly, the way I view it is you get stopped out on the same day. And again, we don't use stops at our shop, but I have been involved with lots of systems that do, and it is a little bit of a point of a confusion. But the way I would think about it is, and Jerry, you can correct me on this one, but I would think of it as if you get a breakout during the day to buy, say gold at 1,500 and you have a stop at 1,450, and later in the day it goes below 1,450, but then you just get stopped out and that's the loss. If it then breaks out tomorrow again and your entry point happens to be exactly the same level, that is the risk. That you can have a number of false breakouts in close succession. And if you do see that repeat often, maybe you need to review the method somehow. But I don't think you can avoid having these situations on occasion. That's just my initial gut feel, Jerry. What do you think?
Well, I think what he's saying here is some things I've run into before, and I think he has three different ideas. And I would just say, to begin with, I think all three are created equal. They're about the same. So say if you're don't think you have to do the back test. If it closes above the highest high, that's fine. That's about the same thing as buying the breakout intraday, and they're about the same. And I think initially I thought the question was going to revolve around that system, buying the breakout intraday, and then feeling bad about it closing below the close or that high or the highest close. But that's, of course, that's to be ignored and just follow your exit rules. But I think the third thing he's talking about is something that I've done as well, which is it has to close above the highest high, and then the highest high, the market keeps making a new highest high, but it doesn't close above it. so it's like one ATR, two ATRs, three ATRs. You're not getting in the trade, or even worse, you're not getting out. So I've just trust me, I've experienced this personally. So come up with a little technique to where you don't have to keep doing that. Probably I would just choose one or the other. Buy if it closes above the highest close, or buy the breakouts intraday of the highest prices. I think those are two great solutions. And focusing on where it closes from where you bought it without it being triggering an exit is something you should not focus on.
Cool. Great stuff. Well, I hope, Drew, that was helpful. And as I said, we certainly appreciate your question. Jerry, what do you have anything else you want to? I'll run through the numbers as I normally do. But is there anything before we get to that you want to pick up on? Something that kind of come to your mind as we've been talking the first 58 minutes today?
Not really, but if I think of something when you're done, I'll let you know.
Okay. So these numbers are as of Thursday. So they include some of the news we saw with trade deal and Brexit. The beta 50 index is down 1.05% in December so far, up 5.96 for the year. The SocGen CTA index down 1.04%, up 5.82 for the year. The SocGen trend index down 1.43%, up 8.26 for the year. The SocGen short-term traders index down 0.74% for the month, up 2.64 for the year. And the Bridge Alternatives Index, the flat fee funds index, down 2.07 for the month of December and up 7.33. Now, I had a little bit of internet problems in our recording, so I'm going to wrap it up now. Thanks so much for joining us this week. We hope you enjoyed it. And if you want to help other people discover the show, please do leave a rating and review on iTunes. We've had some nice ones in the last few weeks, and we really do appreciate those of you who take the time and do that. It shouldn't take long. So from Jerry and me, thanks so much for listening, and we look forward to being back with you on the next edition of The Systematic Investor. And in the meantime, have a great week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of the Systematic